Okay, so when we were looking specifically at the tax consequence, just remember if there's a loss, you'll have a tax saving. Right? If it's a profit, there'll be a tax payable that you'll actually have to make. Okay, you'll have to pay SAR something. Remember, you're offsetting those two, right? So you can see, right, when I'm looking at the tax, the actual tax, only the tax is relevant, okay, not the profit. Okay, remember, the profit isn't a cash flow. Do you notice that you're not including a profit here? Okay, you didn't show that 120,000. All you showed was this, because this is a relevant cost. That is cash flow. Okay, so earlier we said depreciation is a non-cash item. That's correct. Profit on sale is also a non-cash item. That's also correct. You don't include those two in your calculation, but they're part of the working to get the tax consequence. Do you see why that's important? Right, so that's why you have to show all this working. So as an asterisk, show the additional calculations. Okay, especially if they've given you information relating to it. Okay, what we spoke about earlier, the carrying value, show that calculation. Working out the difference between the proceeds and the carrying value, getting the profit on sale being at 120,000. Show that working. Right, they're probably going to allocate marks for this. This might be a mark, it might be 2 or 3, depending on how many workings you've got to do. But show the workings just in case. Right, and then obviously what's relevant, okay, this column here is look at the relevant costs. Right, so remember the format, less after-tax proceeds of the old. This is the actual cost that I'm going to need in my calculation. After taking the changes in working capital, that gives me the initial investment. Right, are all of you happy with initial investments?
Yes.
Okay, just to show you how this fits in with the timeline. Okay. Where's that final timeline? Here, this one. Okay. This figure is going to be inserted here. Initial investments. All right, the amount that we just calculated. All right, so the amount that I've calculated, if you've got this page, okay, insert that amount there. Okay, that's the initial investment. Initial investment is here at the beginning. Right, and that's calculated from this working here. Right, so you need this whole working, this entire working, just to help you get one amount. Okay, remember this is a much bigger question. Okay, this is the initial investment. That's what we're going to be inserting there. Right, and you'd put the amount in. Right, from the previous slide. Make sense?
Yeah.
Okay.
Yes.
Now we need to change focus. Okay, remember all of those slides are separate. That's one working. Okay, the next working we need to do is this one. Right, so in this working, we need to calculate operating cash flow. I need to look at all the new cash flow. I need to look at all the old cash flow, and I need to look at the difference between the two. Right, so how do I do that? Easy. You've got another template. Go back to your notes. Okay, this is where OCF starts. Okay, this is just the question. All right, so I've just given additional information. This is additional information. This is what you would have pulled out of the question. Okay, so again, you've read that whole page of information. Okay, you're looking for information that relates to the new and the old assets. Right, so there's the new. Okay, the new is easy. It's the same amount every year. The old, though, is a bit different. Okay, it can be the same. It can be different. It all depends on the question. Okay, so I've just tried to give both here just so you've got context. It doesn't matter if it's the same every year or if it's different every year. All you have to do is draw up the cash flows for all the years, right? And you can use a table for that. If I was in Excel, I would draw up a table. If you're doing it in the exam and you're writing this down, just drop a table, or you can do it separately. It's up to you. But make sure you've got these headings here on the left. Okay, those headings, depending on the complexity of the question, sometimes they might give you this, and then you've got to work out from this point onwards. So from there, okay, all the way down to the bottom. Sometimes they might even give you this, and then you just need to add the depreciation. Right, it all depends. Okay, I don't know where they'll give you information, but this is the template, this is the format. Okay, this is actually accounting. Okay, the only difference is you're taking your accounting and you're making it finance because you're going to add back the depreciation. Okay, revenues accounting, less expenses gets you earnings before depreciation, interest, and tax. Okay, that's what EBDIT stands for. Right, I less the depreciation, that's the red. Okay, then I get earnings before interest and tax. Okay, if there was interest, you could remove the interest. There's no interest here, so ignore it, 0. Okay, then less the taxes. Okay, the T is the taxes. Right, once you've done that, then you get your net operating profits. Just remember, once you've done that, because this is accounting, and remember we're looking at finance. Okay, in finance, you're looking at relevant costs, money flow, cash flow, inflows, outflows. We're not looking at income and expenses. Right, that's why you've got to add back depreciation. Right, and for showing all of that, you're going to get marks for doing it. All right, so make sure you follow the right approach. Make sure you show all those calculations. All right, once you've done all those workings, you're going to get this. Okay, remember, this is for the new machine. Okay, this was relating to, where was it? Here. Okay, the new machine. Remember, the new machine is going to have revenue and expenses for the next 5 years. Okay, so I've shown that. I've got my revenue and I've got my expenses. Right, here, I've got my revenue and my expenses. I could have actually said this is year 1, 2, 5 actually. Okay, maybe we could just add that. Right, because it's the same every year. Okay, so every year it's going to be the same for the new machine. Okay, I've shown that on the slide here. You'll see it. Okay, there's the new machine. You can see the same amount. Year 1, year 2, year 3, year 4, year 5. It's all the same. Why? Because it's the same operating cash flow every year. Okay, if it's different, right, then you would have to do a separate calculation for each year. Does that make sense? Is everyone happy with that?
Yes.
Okay, so follow the template, use the template as is. Don't change the template, just use the template. Just slot in the amount that you need. Do the calculations. Don't forget to add back depreciation. There will definitely be a mark for that because that changes the accounting to finance. Okay, and then you need to do the next asset, which is the old asset. Okay, just be careful with the old asset. Very, very similar to before. We spoke about depreciation. Okay, it's still relevant. It's relevant because there's going to be some sort of benefit. Okay, so if you subtract, okay, it's going to be a benefit. Your taxes are going to be less because of the depreciation. Right, so we still need to show the depreciation, okay, for the old machine. All right, and I've done that calculation. I've just done it for the 1 year. Okay, if you want to practice, you can do the other years. You can practice, you can do year 2, year 3, year 4, year 5. See if you can do that. Okay, and then check it with these answers. Okay, the answers are there. Okay, there's the old machine. Okay, there's the calculation for the first year. There's the detailed calculation. Okay, you would do the same thing for year 2, year 3, year 4, year 5. Okay, if you don't get the same answers, then you're welcome to message me, text me, email me, and then I will share the workings with you if you don't get it. Okay, but yeah, just a note, we're looking at operating cash flow, all right? So where are we on the timeline? Let's go back. Okay, we're looking at operating, so year 1, year 2, year 3. So OCF 1, OCF 2, OCF 3, 4, 5, etc., etc. Right, do you see how you're building this diagram? And then eventually you could even do time value of money and you could discount all these future cash flows back in time. Does it make sense?
Yes.
Okay,
Yep.
and this is what you're doing when you're looking at capital budgeting. Capital budgeting is you're trying to create a system, okay, that shows all the future cash flows of this particular project. Okay, this is the project that we're hopefully going to accept or reject based on the NPV and IRR calculations. All right, but this is where it starts. Okay, remember that diagram with the arrow? Okay, step number 1 is understanding cash flow, relevant costs, being able to calculate the initial investment, then all the operating cash flows. Okay, once you've done all of that, you're going to have this nice big picture. Then we're going to move a bit further, and then we're going to look at those calculations, because then I just discount everything back, and I solve for these NPV calculations or IRR or payback period, depending on what I'm looking at. All right, so far so good. Are you happy with the initial investment and the operating cash flow?
Yes.
Yes.
Okay, this one does come up sometimes, but they generally don't ask it too often. Okay, just a little note here. I've put this in bold and in green. Make sure you remember that this relates to the end of the period, not the beginning, because remember, if we're painting a picture, okay, we're looking at TCF. Okay, terminal cash flow. Terminal cash flow is here at the end of the life of the project. Okay, so when you're looking at amounts, those amounts need to be at the end of the project. So they need to give you an expectation. Right, so I did that here on the slide. Okay, your template, okay, so template-wise, this is another important slide, page 32. I didn't mention that earlier, but I'm just going to mention it now. Page 29, okay, that template. Okay, it's the same template on page 29 and page 30. It's just depending on which you're looking at, old or new. Okay, so that's the template that you're going to be using to calculate OCF. Okay, for TCF, it's the same as initial investment. If you look at this slide and you look at the previous one, this one, okay, it's exactly the same. The only difference is you're looking at the end of the 5 years. So this is the additional information. And that's why I've put it in a block in blue. Okay, I've tried to make it stand out. Please understand that you're not looking at the current situation. So remember earlier on, I had 600,000, okay, is what a buyer would offer, okay, on that old asset. Remember, when I get to TCF, okay, this terminal cash flow is looking at the new asset that's going to be sold at the end of this project. Remember, we said we're drawing up a timeline. We're building up all of these cash flows. This TCF is the terminal cash flow for the new being sold. Okay, so when I get to the end of the project, because I've bought this project, or I've taken on this project, I've bought this asset, I've replaced the assets. At the end of the life of this project, okay, how much cash flow am I going to get if I had to sell that old asset now? Okay, old asset in inverted commas, because 5 years would have transpired. Does that make sense?
Yes.
Okay, so please keep that in mind. It's the new asset at the end of 5 years, not the old asset at time 0. That's a completely different asset. Okay, something else to consider is the old machine as well. Remember we said earlier, the old machine is always going to be considered relevant. Relevant because it's still part of the business's operations in terms of this decision to replace. Okay, so if I have an old machine and they tell me the old machine still has some value, okay, so I'm telling you the old machine still has some value, even at the end of the life of the project. Okay, remember, you might be wondering, well, how is this still relevant at the end? Because you sold the asset. You sold the asset, but it's still relevant because, remember, it's a cost that's attached to the old asset. So had I kept the old asset, had I not replaced, had I kept it, there would still have been some value. This old machine could still be sold for 80,000. Okay, and this 80,000 is at the end of the life of that project. Okay, the current project, the current existing project, which is now going to be at time 5, which is at TCF. All right, so I'm trying to make this point clear because it has to relate to the end of the project. Okay, and then once you've got that information, so you've got all that information, okay, let me ask you a quick question. At the end of the life of the old asset, is the old asset going to have any carrying value?
No.
No, it won't. Correct. Okay, so if you're looking at the calculation, okay, I'm going to have 24,000, all right, being the tax on the sale. Why? Because the carrying value would have been 0. All right, so it's easy to calculate. Okay, and that's generally normally the case. Right, so when you're looking at the same template, nothing different. Only difference is, here's the note, book value is now 0. Okay, remember, the new asset that's now 5 years old, okay, is going to have 0 book value, so that's going to be the full tax, Okay, and then that old asset that I had sold or that I'm going to sell or that I'm going to replace, we still need to consider this at the end of the life as well. Okay, because it could potentially be a cost that I need to build into the calculation. So that asset has 80 and 24, and then you get the 56. Right, after you've done the same calculation, same as before, initial investment and TCF, they have the same template. Okay, so you don't have to study two different templates, it's one template, but two different points in time. Okay, initial investment is here, TCF is there. Right, once you've got all of that, then you're going to be discounting all those cash flows back in time. All right, so we're going to be looking at that next. All right, that's the next bit. Let me just show you this. Okay, remember dividend discounting, TCF, discount future cash flow. Okay, we're going to discount all of this back, and then we're going to take all of those, okay, back. And then we're going to compare that to the initial investment. Right, so when you covered NPV, net present value, which you're going to see now, okay, I'm just revising theory. Net present value is basically the present value of your future cash flows, okay, present value meaning discounted to time 0, okay, less subtracting initial investments, okay, and that's going to give you your NPV. Okay, so if your future cash flows, in other words, if all of these cash flows are very, very big, very, very positive, even when I discount them back in time, let's assume the present value of all the future cash flows, including the TCF, comes out to, let's say, 100. I'm just going to keep the number small so it's simple to interpret. Okay, and let's assume that my initial investments was 80. Okay. Obviously, your net present value is going to be plus 20. Does that make sense?
Yes.
And this would be NPV greater than 0. So if NPV is greater than 0, we would accept the project. Okay, and you will see this in some of the past papers that I've shared with you. Right, you will see sometimes you've also got to calculate that as well. All right, where you've got to determine NPV, if it's positive or negative, okay, based on the weighted average cost of capital. That we haven't got to yet. We'll get to it later. Okay, that would be the discounting rate. Okay, because remember, this is just the project. Remember, I'm trying to paint a picture. Okay, this is everything to do with the investment. Okay, how much benefit is this project investment asset going to generate for us? Okay, net present value is a measure of that. Okay, the financing is different. That's something separate. Normally, they'll give you a rate here. You're not going to have to work out WACC as well. Okay, that's too complicated. If they give you a capital budgeting, they normally give you the weighted average cost of capital. Right? They don't also ask you to work it out. Okay, because they're asking you to work out the cash flow. If they've given you the cash flow, then generally they might ask you to work out the weighted average cost of capital. Okay, you won't see both. That would be quite unfair, because if you've made mistakes in the one, you're going to get the other wrong. So the examiner wouldn't do that. All right, everyone okay with that section?
Yes.
Okay, please have a look at the study guide. I did squiz through it just to have a quick look at it. I did see there are some really good examples there that also speak to the workings. Okay, you can always make use of that. The textbook is amazing. Definitely use that as your main source of information. And if you have any questions, you're more than welcome to communicate with me. Okay, even after today, I don't mind. Okay, all right. Study unit 2. This is a whole bunch of time value of money. All right. So I hope you've got those financial calculators close. You're going to do some calculations now. We're going to check if you can do your calculations on the calculator. If you can't, I'll help you. If you can, okay, we need to look at it. If you can't, we need to look at it. If you can, then everything's good. All right, just a little note. We spoke about capital budgeting. Remember, we looked at the cash flows. Here, we're looking at the techniques. Techniques meaning we're moving towards the analysis. Okay, remember I painted that picture of that the steps that you would have to do in terms of practical application. UNISA is going to test you on 2. Your analysis and your evaluation of the project, which is calculations, and the last is the decision making. That's it. The rest you don't have to worry about. Okay, so if I looked at this cash flow, you can see project A and B. Okay, remember, This is basically what we're looking at, but on a very simple example. Okay, we're not looking at every single example, calculating all of these. These are actually OCFs, operating cash flows. Okay, and the last one would have OCF plus TCF. Okay, they would be combined. Okay, so if I'm looking at this project, conventional, non-conventional, it's conventional, right? There's no outlays. If there's an outlay, it doesn't matter. Even if there's an outlay, you can put that in as a negative on your calculator. Okay, what function are we using? We're using the cash flow function on the financial calculator. Okay, what financial calculators do we have in this class? HP, Sharp, Casio, which ones do you have?
I have a shop.
Yeah, I'm using a Sharp.
Okay, both are using the Sharp. Great, that helps a lot. Okay, so then I'll just focus on the Sharp, then I'll avoid Casio and HP. All right. Okay, capital budgeting. We spoke about timelines. It's very important to use timelines. Always draw a timeline, even in the exam. Okay, you'll see, even in some of the exam papers that I've shared with you, you'll see in some of them I've even drawn up a timeline to help with understanding. I can't emphasize this enough. Okay, timelines help you so much when you have a question that looks at time value of money. Please draw the timeline if you can. Okay, capital budgeting. First technique, payback period. What is payback period? Well, it's looking at the initial investment. When do I cover it? Just be careful with payback period. There's no time value of money associated with it. It's literally just looking at the amounts. How do we know when we accept? When the payback period is less than the maximum acceptable. Right, I have an example for you. Here's the example. Same project, A and B. Okay. If I'm looking at payback period, what would it be? This one you can't calculate using a formula. There's no formula. It's just a normal intuitive calculation. Right, what would the payback period be here? What would you do? Do you know? You would have done this last year in FIN3701.
You first got to calculate how long it would take you to get your initial investment paid off over your years.
Correct. Okay, so 140 plus 140 is 280. Okay, 280 plus 140 is 420. What's the payback period for this one? 3 years. Make sense?
Yes.
Okay, this one, same thing. All right. You would add up and you would see where's the payback period. So those two amounts added is 400,000.
Yes.
Okay, then I'm going to have half of that. Okay, so this will be 2.5 years. Make sense?
Yes.
Right, and that's payback period. Payback period, very, very simple. Just remember, how do I get the half years? If you have a portion that's not the full amount, just take what you still need. Okay, so what do I still need here in the final year? If I look at the difference, it's 50,000. Okay, so in the final year, I need 50 of the 100. Okay, that's why I got a half. Right, this could have been anything. If it was 120, I would have had 50 over 120. Then I would have got 2 comma something years. Does it make sense?
Yes.
Okay. Right, so we've looked at payback period. I've given a few others to look at. Those ones, before I reveal, maybe just give me the answer. Gold. Parosha, you can do gold.
Yes.
Damien,
3 years.
silver, do silver. Let's see what you get.
3 years for gold.
Nice. And Damien, silver.
Working it out. Yeah, 3 years.
3 years well. Okay. So both of these projects have 3 years. Okay. Why? If you add up those amounts, you get 500,000. If you add up those amounts, you get 500,000. Okay. The lesson to take away from this slide is have a look at the cash flows. Are these cash flows equal?
No.
No. Project Gold doesn't give much in the beginning, but more at the end. Project Silver gives more at the beginning, but less at the end. Okay, and this is why payback period is not very good, because it doesn't take time value of money into consideration. And that's why we have something better, which is called net present value. Right, there's another one here. Okay, same thing as well. 500,000. Okay, 3 years for that one. Right, for this one, it'll be a lot shorter. Okay, if I'm assuming a 2-year minimum or maximum, okay, obviously if it's more than 2 years, you would reject. If it's less than 2 years, you would accept. Does that make sense?
Yeah.
Okay, so
Yes.
in this
I had
scenario,
just
project,
a strange one. Sorry. On this assignment this month, we had to do this payback period calculation, and it
yes,
stated there that the acceptable payback for the company, I think, would be 3 years or something. Or 2 years,
okay,
and when you calculated it, gives you 2.75
yeah,
years.
that's still longer than
So
2.
yeah, so basically your net present was positive, and your IRR was positive.
Yeah, but payback period
Um,
wasn't right, eh?
Correct. So
Nice. Yeah, that's a good question.
in my answer, I stated there that the project would be rejected because your payback is not
Yeah,
accepted,
but still a
which
good
is
project
incorrect.
overall.
Yes. So
100%.
the lecture said it was your RRR and your
NPV
NPV
was
was more
positive.
important. Yes, it was more
Definitely.
important than your payback.
100%. Yeah, and that's exactly what this is trying to show you, right? Because remember, time value of money isn't taken into consideration here. So really great observation. So yeah, thank you for sharing that. That's an amazing observation. You probably did very well in that assignment if you made that
No,
same observation.
no, I
Good
didn't
job.
make that up.
Great effort there. Okay. Right. So I think payback period is okay. I think most of you are comfortable. This is just something additional. I haven't really seen this come up, so I don't want to spend too much time on this. I'd rather get to NPV and IR. I'm just going to show this on screen, okay, just so you can see the workings. You can always go back and reference this if you need to. But this is just looking at if I have tax, okay. This is important to note because taxes are relevant. Okay, so if I have tax, you always need to take out the tax. Right, so just remember that. Okay, you do take out tax when you look at those other calculations, but not so much for NPV and payback period. I haven't seen them bring that consideration in, but you will see it later. So the reason why I'm giving this to you now, I'm just saying consider taxes. When you look at leases, okay, we'll get there eventually. In a lease calculation, taxes are important because certain payments are tax deductible and certain payments aren't. Okay, and that's why we need to consider whether something is tax deductible or not. Okay, so this is just purely a note just to give you an additional consideration. Okay, when looking at practical questions, irrespective of what the type of question is, you always need to consider taxes, even if it's payback period as well, because payback period means, well, if I'm going to be generating a certain amount of income, there's obviously a tax consequence as well, right? If the estimated cash flow is before tax, I need to look at after tax in order to work out the payback period. Okay. All right, let's get to net present value, the next one. Okay, NPV. We've seen it before. I've given you the slide. Just remember, that's the important one. Projects are accepted if the NPV is positive. Okay, the advantage with NPV is you're taking time value of money into consideration, and that's very, very important. Right, here's just a note about the discounting. Okay, we spoke about it earlier. Remember, your job is to get all of these amounts. Get the NPV. Sorry, I said NPV. Okay, to get the NPV, you need all the cash flows. You need the INV. Okay, you need the INV being the initial investment. You need the OCF and you need the TCF. Okay, what we created earlier. All right, so we're just building on your basics. Okay, your basics came from before, right? Once you've got all of that, then you can do all of this. All right, that's what I'm trying to do here with this slide. Okay, just remember how everything fits. Right, so let's test your knowledge. Okay, I'm going to leave the answers up. I'm going to ask you to grab your calculator just to check if you can do these. Right, can you get project A and B's NPV? Maybe let's do it again. Parosha, you do A, and then Damien do B, just to test your knowledge. If you don't know how to do it, then I need to help you. But I'm going to ask you to try do it and see if you can. Can you do NPV? Are you able to insert those values?
Yes.
Okay, please try it for one of them. So try check A, Prosha, and then Damon, try check B and see if you can get it. Right, if you can't, then I need to go through the workings with you in detail. Okay, let's use that as a test your knowledge, test your skill. Right, if you're good with this, then we can move on. If you're not, I definitely need to spend more time with it. How are we doing? Any answers yet? Okay, remember there's a cost of capital here. Right, cost of capital is basically weighted average cost of capital, WACC. In these type of examples, okay, you don't know how to calculate that yet, and that's why it will be given. Right, even in that previous example, when we did that initial investment, OCF and TCF, right, if you've been given a long question, generally they'll give you the cost of capital. They're not going to ask you to work that out as well. That'll be done separately. Okay, so you're discounting using the 10%. Okay, don't forget initial investment. Remember we spoke about initial investment being the cost, the outlay. That must be negative. So when you're using your calculator, please remember to insert a negative there. Otherwise, you will get a different answer. Okay, all of those amounts need to be positive when you're inserting that into your calculator using your cash flow function. How are we doing? Are we getting these? A and B? Okay, there's silence. I'm a little bit worried. I'm going to ask you, do you need some help?
Sorry, I'm still listening.
Still busy. It's fine. Take your time. Make sure you can get it. Damien, can you get it?
Okay.
Yeah, I'm still
busy as well.
calculating.
Okay, I got the correct answer
Okay, you managed to get it.
for project B. Yes.
Oh, you worked out B. Okay, that's fine.
Sorry, project A. Sorry, project A.
A. Okay, yeah, that's fine. Doesn't matter which one you did. If you did A, that's fine. Okay, so at least you can do it. So happy that you can do it. As long as you can do it, that's key. If you can't, then I'll guide you step by step. How are you doing, Damien? Did you manage, or do you need some help?
Yeah, I think
Need some
I've
help.
got it, yeah, but I need some help.
Okay.
Do it again.
Parosha, because you've got
Yes.
the calculator in front of you, just
Yes.
work through the steps. Let's go back to A.
Okay.
Okay. I'll note it down just so we can add it here.
Okay.
And then I'll make the notes. Okay, so there's a
So
button. Obviously, second function, clear your calculator. That's the first thing you need to do. On all calculators, David, make sure you
Yes.
clear your calculator. Okay,
So
I think there's an M clear
CFI
button on your Sharp.
CFI second function and then CA.
Okay, there
clear.
we go. All right, so clear the
Then,
calculator. That's step number one. Okay,
Okay.
continue.
Then it's a negative. Okay, I'm doing project A. Is that fine?
Yeah. Go with project A. So Damien, follow the steps. So Parosha, just tell us exactly which steps you're doing, and then we'll
Okay.
just note it on screen as well.
Okay, so it's a negative 420.
Okay, so type in negative 420, and then which button do you press?
And then you
It's a
press
CFI, right?
it's ENT on the Sharp calculator. It's
ENT. Okay.
then the 140.
Okay, then you
And
type in
EN
140 and then press ENT again, right?
Yes, correct for all the cash flows.
Okay, so do that for all, Damien.
Yes.
Okay.
All right, and then after you've done all of that, maybe just wait for Damien. Damien, have you done all of that? So you've inserted the negative 420, then you've done 140, enter, 140, enter, 140, enter, 140, enter 5 times.
Yep.
You with us?
Done, yep.
Okay.
Okay,
next
then
step,
it's second function cash
second function cash
or CFI, I'm not sure.
or CFI.
Yeah.
Right. Then 10.
Yeah, then you need to put in the rate. 10,
Yes, which is 10. And then it's enter again.
10, enter.
And then it's the arrow coming down that you press.
Arrow down, and then you need to go to the
And then
NPV
comp.
comp.
Yeah.
Yeah. Okay, go to NPV comp. All right, so if you follow those steps, we've got them on screen here in case. Did you manage that, Damien? Damien, did that work?
So answer was 110, 700. Yep, I got that one.
100%. Okay, that's perfect. That's right. Yeah. Okay, I was a bit worried there. I thought maybe you struggled, so I just wanted to bring up the calculator. Yeah, so this is the sharp. This is what it should look like, right? Is that what your calculator looks like?
Yes.
Okay, yeah, so you can see all the, yeah, there's the M clear second function, and then you've got those buttons with the CFI for cash flow. Okay, and then you've got the second function cash. Interesting. Okay, great. Yeah, thank you for assisting there, Parosha. That definitely helps save some time.
No problem.
You happy with that working, Damien?
Yes, much better.
Okay.
I was doing it manually.
Yes. Okay. I will leave that up. Maybe I'll send it to you afterwards if I remember. If I forget, just maybe note it. But I'm sure you should be all right. I think even in the study guide, I remember the DSC. If you've done DSC, they gave those steps for the calculator for the one module, the 1630, because they recommend, UNISA recommends Sharp or HP. Those are the two calculators that they recommend. Right, are you happy with that?
Yes.
Okay, maybe let's just test you with one more. Damien, maybe at Prosh, if you want to test your knowledge as well, just to practice, can you do one of these? Let's don't do both just for the sake of time, but I'll leave the answers up here. You can maybe jot them down or note them. All right, Project Gold, if you can discount those future cash flows back in time to calculate NPV, notice though, the return is 22%. Okay, see if you can get those NPV. Both of them are negative. You would reject both of these projects. Right, let's just do one. Let's all do Project Gold.
Okay.
Okay, Damien, following the steps. So clear the calculator and then negative the amount, enter, and then do the second function, the rate, and then arrow down and then solve for the NPV. See if you can get this one. Okay, let's just do gold and just check it just to make sure. As long as you've got this, then we're good.
Yes.
Managed.
Much better.
Yes.
Okay, great. Well done. All right, then again, just note the answers if you want to do more practice. Here's the answer for that one. And I'm going to show you the answer for the other one as well. Okay, here we've got another 2 to practice. You've got X here. There's the answer for that one. Okay, let me just put some gaps here so you can read the numbers a bit better. Okay, and that's the answer for Y. Okay, so there's more workings that you can do just to practice if you're on the right track. Right, IRR is exactly the same as NPV. The only difference is you're not working out a rand amount, you're working out a percentage that's going to look at all of those cash flows, bringing them back in time, that makes NPV 0. Okay, luckily, we don't have to use the Newton method. Okay, that's a repetitive mathematical process. All we have to do is just use the calculator. Right, so again, just to help Damien with that, the process should be exactly the same. So you should enter in all the values up until the end. At the end, then the process changes because you're looking for IRR, not MPV. If I'm not mistaken, I think you just compute the rate instead of putting one in. Is that right? Or Parosha, can you just
Yes, that's correct.
Okay, yeah. So you compute the rate part instead of inserting a rate. So earlier we had to insert like the 10% or the 22%. Okay, so
Yeah.
this is the same project as before. We had project A and B. Okay, you're going to ignore the cost of capital. Why? We're calculating the IRR. Okay, we're going to discuss this just now because we need this in order to accept or reject. Okay, the first thing I need to know is you need to be able to calculate this. All right, so same as before, Damien. Insert initial investment negative 420, enter all those figures. Okay, when you get to the end, then just remember, don't insert any rate, just compute that rate. And let's see if you can get this one right. Okay, all practice and see if you can get that. So A, see if you can get the 19.85%. Try do that working for A.
Got him, yeah.
Sorry, say that again.
I got it. That was a nice one.
Okay, great. Well done. All right, so happy with the calculation? Parosha, did you manage?
Yes. Yes, I'm happy.
Also
yes.
happy. Okay, again, please just note these answers down. You can maybe do these others as additional questions to practice. All right, that's the answer for A, and that's the answer for B, 21.65. Right, there's a few more, but because you know how to work these out, I'm just going to reveal the answers. You can practice these in your own time. All right, gold's answer, if you work out IRR, okay, IRR is 11.23 for gold and 17.66 for silver. Okay, this is worthwhile discussing it. Okay, because later on you will all work out 22% required rate of return. That's a CAP-M calculation. You did CAP-M last year in FIN3701. Okay, we need to recap that as well. Okay, we're also going to be looking at WACC calculations, weighted average cost of capital. All right, that's also something we need to look at. Okay, so when looking at gold and silver, what did we work out? We worked out the IRR, internal rate of return. Okay, what does that mean? Let's go back to the slide here. Internal rate of return gives me a rate that's representing those future cash flows discounted back in time to get an NPV of 0. Right, so it's an internal rate of return. Internal meaning those cash flows, what rate are they providing us with when I have an initial investment? Even if you go all the way back to that summary we did here, okay? Remember initial investment? Initial investment is an outflow, okay? This project is going to bring in operating cash flow and then some money at the end of the project, okay? If I'm looking at IRR here, IRR is basically telling me if I had to invest an amount of money, okay, the amount that we had earlier, and it generates those cash flows, what rate does that actually give us? So if we're talking about IRR, that's the rate that we've got. So for example, if we go back to that one where we had the 22% here, okay, this is the rate of return that each project is going to give me as a return. In other words, if I take out 500,000 and I invest that 500,000 in this project, I'm going to generate 11.23%. And if I take out 500,000, and if these projects are independent and I can choose both, Project Silver is going to generate 17.66%. Those are pretty good returns on investment, but the problem is, if the required return, or I could even have said here, the WACC. Okay, if the WACC or the required return was 22%, what does that actually mean? Well, remember, we're going to talk about this later. I'm just highlighting it because it comes up later. Weighted average cost of capital. Okay, I'm just trying to link something you know now to something we'll look at later. Okay, remember we said financing is a separate decision. All we've looked at now, okay, this morning is investing. Okay, we're going to change later on and we'll look at financing. When we talk about financing, this is what we're looking at. Okay, if I go raise money in the market, if I issue debt and equity, okay, it's going to cost me 22% as a weighted average cost of capital for this particular company. Right, so if they had to raise 500,000, it's going to cost them 22%. This project only generates 11% or 17%. That's not good enough. That's why you would reject the project. Right, does the theory make sense?
Yes.
Okay,
Yeah.
the theory is important because I've seen longer questions where they've given you WACC and IRR in the same question, and they've asked you about that whole accept reject criteria. Right, there's a diagram you'll see later in one of the notes about it. Okay, right, then just to add some more, IRR here, X is quite a nice one to do because it's actually 0. There is no internal rate, right, because all of those outflows equal the initial investment. There is no internal rate of return. Okay, and then Y, if you do that calculation, just to give you an answer for it, it's 24.28%. Okay, then I've just summarized everything here, just highlighting the important notes. Remember, ranking is important. Right, the only reason why I've given you this is because in one of your past papers, okay, if you go look at some of those past papers that I've shared with you, you'll see one of the questions have given you multiple projects. And then you have to use ranking and you have to accept and reject based on the minimum criteria. It could be based on capital. Maybe you run out of money. Okay, for example, this project is going to cost me 420. This project is going to cost me 500. At some point in time, I'm going to stop accepting projects because those projects require too much money. Okay, I need to raise too much capital. All right, so just remember that. That's just something to fit in with your theory. Always remember that NPV is the best approach. Right, Damien mentioned that earlier in one of your assignments. Okay, that was noted. So payback period was reject, but NPV was positive and IRR was positive. It was greater than cost of capital. You would definitely accept those projects as long as they create value. And then the last slide here is just something that's noted in terms of this equivalent annual annuity. Okay, this is just a refinement when they talk about this profitability index. Okay, this is actually from your FIN3601. Okay, this is just a note that I've included here for your benefit in FIN3701. I haven't really seen it come up, so it's not that important, but if it does, at least you have a note. Okay, when you get those NPV calculations, let me go back to one of these, like this one, for example. Let me get one that is positives. Okay, those two, A and B. Okay, when you've got NPV that's positive and you've got NPV that's positive, let's assume that project A had 5 years and project B had 6 years or 7 years. Sometimes it's necessary to use this, an equivalent annual annuity, okay, where you're basically taking your NPV figure and you're annualizing it. Annualizing it meaning you're computing a PMT, so you're getting an annuity figure and amount, okay, to compare projects, to see what the annual amount is. Because if projects are different lifespans, one might be 5 years, one might be 10 years. Okay, even though the one might have an NPV, but it's a longer project, so you would expect more cash flow. Right, then you've got a shorter project which has less cash flow. Right, if you have projects that have unequal lives, then it's better to use an annual equivalent. Okay, but yeah, this is from FIN 2601. Okay, it's just an additional consideration. All right, that covers another chapter. Okay, we've covered the long ones. Okay, those are the long chapters. Those are the hectic chapters in terms of the first session. I'm just monitoring time. Okay, we're still doing all right. How's my battery doing? Yeah, I still have another 53 minutes. That's fine. Yeah, the load shedding will be back. I do have an inverter, but I need to put it on. So power should come back on for me at 12. So yeah, that'll be fine. I'll charge the laptop in the meantime during the break. Okay, before we get to the break, I just want to cover a little bit of theory. Okay, I know we've covered quite a lot. I will give you a break just to refresh and to get some more coffee into the bloodstream, okay, and caffeine just to get through the next bit. from this point onwards, it's not too bad because everything is in isolation. Okay, we don't have these massive questions. Okay, the biggest question that you're ever going to get or potentially going to get is this one, capital budgeting. Right, you will get questions on all these other things, but generally they're quite small. They're quite like separate. For example, a WACC calculation, right? It's separate. Okay, it's on its own. Okay, other calculations, leverage, it's separate. It's on its own. Okay, let me think of other calculations. CAP-M could be a separate calculation. Right, so this is just some additional considerations, risk and refinements. Okay, when we're looking at risk, what is risk? Let me ask you quickly. What is risk? What is risk? If you had to explain what risk is, what would you say risk is? Anyone? Okay, yeah, I see it timed out again. I was just wondering what happened there. I asked a question about risk. Okay, Damien,
Yes.
can you see the screen? Are we back?
Yeah, I'm back.
Okay, great. All right, let's just give Parosha some time.
Leverage falls like hand in hand with each other.
Well, leverage is a form of risk, definitely, because if you're taking on more debts, there is going to be more risk. So risk is something that you need to measure and you need to build into your calculation.
Okay.
Yeah, so risk is basically uncertainty. All right, so yeah, let me just message Parosha and see if she's going to join us. I'm going to ask her, please come back. I see she just asked about the break. Okay, I'm going to just put up the slides in the meantime and just speak to some of the theory while she's on her way. So just in terms of risk and these refinements that we have, basically we're looking at the impact that this has on cash flow. Okay, so remember, in everything that we've looked at so far, all of it has assumed that everything is set in stone, that there is no uncertainty. There is an assumption that there is certainty. So that's the problem that we're in, right? So if you've looked at chapter 8 to 9 in the textbook, nothing has assumed risk yet. Okay, everything has assumed that there is no risk. Right, so these last few slides in study unit 3 is just highlighting these slight refinements that you need to do in order to create a better decision or to make a better decision, in order to create cash flows, right, or a rate that builds in risk. Right, so this isn't so important from a test point of view because the only time that I've ever seen this come up is where they've given you like certainty equivalents. I've seen one question testing that, where they've given some certainty equivalents, and I've seen another question where they've given you a risk-adjusted discount rate. Okay, so just to highlight the content here, in practice, you would obviously have to look at risk and how that affects your cash flow. The others are additional, that's beyond the scope. You're not going to be tested on scenario analysis or simulation. Okay, what is risk? Damon actually explained it earlier. Something like leverage could be a form of risk. Right, risk is just uncertainty where we have certain things that could potentially change. Right, so you can change your view or your perspective. Right, the price of oil can increase. That can affect your costs going forward. Okay, so risk is trying to build in certain uncertainties, certain things that we don't expect, and those are things that we can build into the calculation. Right, so how do we do that from a test perspective? The only thing we need to do here is look at the cash flows. Right, we need to think about cash flows. Which cash flows are more affected by risk? The ones at the beginning or the ones at the end? Which one do you think?
The ones at the end.
Exactly, the ones at the end. Okay, the ones at the end, why? Because they're more difficult to predict. Okay, so we don't know what's going to happen in 5 years. Okay, who knows where the price of oil is going to be in 5 years? Right, we don't know how much we're going to be paying for petrol in the next 5 years. But in the next month, we know petrol might be going up. Right, in the next 2 or 3 months, we might have an expectation that's a bit more accurate. Right, so when you're looking at cash flow, just note that sometimes there might be a certainty equivalent. Sometimes they ask you to adjust your cash flows. Right, I haven't really seen it that often. I think it was it might have been an assignment question. I'm just trying to think back where they actually gave you like these certainty equivalents, and then you had to adjust the cash flows first before discounting back in time. All right, so if cash flows are more risky, you'd place a lower weighting on them at the end, and you'd place a higher weighting them at the beginning, right, because of the certainty. All right, so for example, if the outflow, let's assume your outflow here was 100,000. Let me just write this down just so it's easier to show. Okay, what is a certainty equivalent? I'm just trying to explain that with an example. Okay, let's assume we had 100,000. Okay, and that was an outflow, that was an expense. Okay, let's assume you're buying petrol or fuel for the generator for the business. Okay, and you're expecting to pay 100,000 now in T1, and you're expecting to pay 100,000 in T5. Okay, if you're using a certainty equivalent, well, in the first year, I'm going to assume that my cash flow is accurate, so I can place maybe a 99% accuracy, right? Because 5 years is quite outside in terms of timeline, maybe I'm only going to be 50% sure that I'm going to be paying 100,000 for fuel, right? So then you place a weighting, a certainty equivalent. Okay, but yeah, it's not that important. I haven't really seen it come up in a test exam question. It might have been an assignment, but just to note it for all of your benefits, just to highlight that note about the cash flow. Okay, when you're looking at break-even cash flow analysis, you will see break-even as a separate calculation. We're getting there, but that's something different. Okay, if it's break-even cash flow, what are we calculating? Can you tell me, what is break-even? Break-even is?
The point where you generate profit after your sales, less expenses.
Well, basically, where your income equal your expenses, right? So if I'm looking at a company, okay, that has an initial investment, right, of 500,000, okay, if I'm working out break-even points, I need to work out where the NPV is 0. Okay, 0 meaning I'm not creating any value. When NPV is positive, now I'm creating value. I'm making a profit. Right, so this is just time value of money. Right, break-even cash flow analysis. When you're looking at questions like this, just think about it logically. It's all broken down back to cash flow timelines. Okay, if I'm looking at cash flow, if I'm drawing a timeline, I'm looking at what is the break-even going to be. So in other words, how much money do I need in order to cover my initial investments? Okay, my income must equal my expenses. So if I'm going to invest 500,000, I need to cover that. Right, so if I calculate this amount, you're going to get 65,737. Okay, that means this project, if this project has a cost capital of 10%, okay, I need more than 65,737 Rand coming in each month in order to break even. Okay, if this project doesn't bring in cash flow of 65,737, it will not break even. Does it make sense?
Yes.
Okay, well, I'm just going to spend another 5 minutes and then we'll take a break at 10 past just to do these last few slides. Here's another slide looking at break even where there is probability of receiving cash. Okay, if I've got 2 projects and project X has a 100% probability of receiving cash and project Y has a 65% probability, which project do you prefer?
Project with the 100% probability.
Exactly. okay, because there's no room or there's no risk. Right, so remember, projects can be accepted or rejected based on the possibility of receiving those cash flows. Okay, if you know project X is a signed, sealed, and delivered type of situation where you're going to get those cash flows irrespective, there's no question mark around the probability of receiving cash, you would definitely go with project X over project Y if both projects are equal, if they both have the same NPV and IRR. Okay. Right, there's a note about scenario analysis. You can look at different situations, pessimistic, most likely, and optimistic, and you can look at these different projects and what their individual NPVs are for all those different situations. Okay, just remember NPV is one calculation where we've discounted things back in time. Right, if I'm discounting things back in time, I want an NPV that's positive. Okay, you can calculate the NPV based on all of those different scenarios. Right, so if I'm looking at scenario analysis, I can say, well, project A is going to cost me $500,000. If I'm more pessimistic, I'm going to get 75,000 Rand cash flow every single year. Most likely, I'm going to get 100,000 every year. Optimistic, I might get a lot more. I might get 125,000 every year. Okay, in each of these scenarios, I can calculate an NPV, and that's what I've given you here. Okay, there's NPV with pessimistic. Pessimistic, even for A, even though I'm only getting a small amount of money, the NPV is still positive. Most likely, NPV is positive. For project B, it gave no cash flow. It was 0. Then it was positive. Okay, it's possible to calculate optimistic as well. Okay, if you do the calculation, just to share those answers with you, there's the NPV. Okay, you've got the initial investment. Okay, discounting future cash flows back in time. Right, to calculate those amounts. Right, those amounts are also positive. If you calculate both, you'll see they're both positive. Right, if I'm looking at this project, obviously project A is better because in all those scenarios, NPV is always positive. This project will generate income, value in all situations. Okay, versus B, which can have a more pessimistic, more negative outcome. Right, and then just one more slide here, and then we can take the break. I'll come back and look at the calculations. I want to spend some time looking at CAPM because it's worthwhile. That's something very important for the weighted average cost of capital later. Right, so I'm just going to end off with these last few slides. Just look at simulation. Simulation, that'll never be tested. Simulation is model building. Maybe if some of you do like budgeting, or if some of you do forecasting, and it can be any model. It doesn't have to be a financial model. It can be a sales model, maybe marketing. It could be anything, operations. It could be costing. It could be internal. Right? A model is just that. It's just a forecast. Okay, it's something that someone has created that has multiple variables that can kind of predict what is going to be happening going forward. All right, these are some of the useful tools that you can use. Standard deviation, you might have covered this if you did stats in one of the courses prior to this. That one does come up, but not in detail, but it can come up. They might talk about standard deviation as a measure of risk. Okay, and there's a note about international considerations. This not so relevant from a test point of view. It's all generally local. And then the last bit, this is important. Okay, this I have seen. Okay, the certainty equivalence we spoke about earlier, and this I have seen. Okay, where risk is adjusted for in terms of the rates. Okay, the percentage. All right, so when you're looking at cash flows, when you're discounting cash flows back in time, just remember, let's assume, okay, you have a rate, a cost of capital rate, or a WACC rate, okay, or a required rate. It doesn't matter which it is. Okay, we'll discuss CAPM later, and we'll discuss required return just to revise that concept from FIN3701. WACC is generally what they'll give you, okay? If the cost is given, let's say 10%, but there's a massive question mark around the risk, okay, because of, let's say, inflation. Okay, we're worried about inflation, right? Even though you've calculated a WACC of 10%, you might say, well, let's adjust the rates to get a risk-adjusted discount rate, because if I discount, my cash flows at 10%. The NPV might be positive if I use 10%. But now, because inflation is a huge consideration in reality in the world that we're living in, and oil prices are increasing, cost of living is increasing, there's a war happening in the Ukraine, etc., we might say, well, there's additional risk. I'm going to add a 2% risk premium. So I'm going to discount, instead of WACC, I'm going to discount at the RADR, and I'm going to use 12%. If I use a bigger rate, I'm going to get a smaller NPV. Okay, and that's why NPV, if it's still positive, let's assume if I'm using 12% and I'm still getting a positive NPV, well, that project, this project that I'm going to invest in, is still going to perform even if there is risk attached to that project. Does that make sense?
Yes.
Yes.
All right, and I think I've just gone, yeah, okay, it's 11:12. Okay, let's take a 30-minute break. So if you can all be back at 11:45. Right, let's start at 11:45, if you don't mind, 11:45. Take a break, relax, refresh. Okay.